Good afternoon, everybody, and welcome to part
Part
two
two
of our
of our
webinar.
webinar,
And
and
excited to get
excited to
things
get
rolling
things
here for you. And if we can just get oh, there we go. We're all muted. We have the sound and audio happening well. We got some great speakers to join us. For those of you that are joining us for the first time, a little bit about Rock Advisors. We are apartment development solution providers exclusively in the rental apartment space. You can see the services, everything from brokerage through research, debt advisory, the whole gamut of everything from education and consulting. We're here to do that with our private developer clients. And you can see the markets that basically is the whole repertoire of rental space, whether it's pivoting from condos, whether it's conversions, affordable housing, student housing, and of course, purpose-built apartments as well. Now, a little bit of housekeeping before I turn things over to our speakers. If you're looking for upcoming topics, we have the stateside returns webinar coming up in a couple of weeks, June 17th. And on the following week, we have What is Rent, featuring our guest speaker, Brian Pierce, will be joining our CEO, Derek Lobo. And we have up there as well, I believe registration is now open for the December 1st conference for apartment development and affordable housing at the Toronto Real Estate Forum. And we will do a little plug here for the National Apartment Council of things to note with their annual general meeting, their AGM in September in Toronto. This is open to
open to
all
all
apartment
apartment
developers. You
developers.
do not
You
have to
do
be
not
a
have to be
member
a
of
member
the
of the
NAC. You
NAC.
can be
Can be
a
a
developer and still join this event and partake with it. Now, Q&A, please use the chat boxes for Q&A throughout the course of the webinar. Our speakers will monitor that. We'll address that. We will have a live Q&A session at the end, time permitting. Similarly, we will make the slides, the recording. They'll wind up on the landing page. You'll see a follow-up email after our webinar with those kinds of details as well. Now, as I said, we're here at part two, the development pro forma. We ran the basics, the kind of the introduction to the whole topic of the financial elements of apartment development. But here's what you can expect from today. Today, we're going to dive into the essentials of the pro forma. We're going to talk about feasibility, which is probably the first place that we get involved with the first deep dive, and the developers obviously start talking about that and doing some work ahead of that. Debt advisory and lenders, we'll have that covered really well, and we'll pull everything together in a considerations conversation as well. And as I said, we'll do some Q&A at the end as well. Now, Kanan, Dave, and Joanne, they'll be chiming in here. I'll have them introduce themselves as they come on for their individual sections, but they will be your primary speakers here this afternoon. But to kick things off, what we wanted to do is let's just do a quick little Zoom poll. We'll put it up on the screen for you because it's always good to get a little bit of a pulse on, what's happening in terms of where the hurdles are, where the challenges are. So if you can just take a peek at this, what is currently your number one frustration with your development project? And just do a single choice here. I think all of them probably we hear of and see that there's definitely hurdles to be overcome. But this relates to not only just the times we're in terms of the marketplace, the financing situations, but also what we see happening at the municipal, the federal, and even the provincial level as well. So we'll give it another 10 seconds here, and we'll get a picture of where we think most of the hurdles exist. And I'm starting to see some trends here, but not to be fully unexpected. All right, let's just end things up there, and we'll get a good feel for that. And definitely just getting pro forma. I guess probably why we're doing this webinar, the pro forma, getting it to work. And of course, that finds its way through a number of the other elements, CMHC and what's happening at the municipal level and things like that. So thanks a lot for participating in that. Good feedback to share with everybody for that. And let's move on forward here. So last month, we did go through a bit of an introduction to the whole financial elements, and I'm not going to go through and reiterate everything, but we definitely dove into a high level understanding of just some of the metrics, what they are, what they're defined as. At the front end of modeling and feasibility, we moved into the financing, what the financing institutions and lenders look at. And we even talked about the most important phases of where the valuation of your building kicks in during lease up and establishing rents. And at the end of the day, you're looking at a valuation and making an asset very, very valuable. We introduced the ideas of what happens at the front end of financing and also what can happen towards the back end. But obviously, we did it at a very superficial level. But today, we're going to dive into some specifics and we'll field questions. I will just kind of tailor the question. Try not to get too specific. Obviously, you can get specific with us at another time, but think about where you're at in your project and keep your questions. I guess that can be shared with all the participants here. So, Dave, I'm going to turn things on over to you to kind of moderate today's content with our speakers. So here's Dave Price. Over to you.
Good afternoon, everybody. As Rod mentioned, I'm Dave Price. I'm the Director of Sales here at Rock Advisors. And we've framed this up, on the screen, you can see the 9 stages of apartment development, but really focusing in on that feasibility, financial modeling, and the financing aspects. And, these pieces work very strictly and directly together and becomes a process for iteration. So, you know, you can see um, you can see up on screen how, things like rents, vacancy rates, construction costs all kind of play together here. Now, what I want to talk to you about first and early on is, when you're in discussions, and again, when I'm in discussions on discovery calls with some of our clients or prospects, and actually I see some familiar faces and names on the screen here, and we've had some of these discussions. Some of the things that we're talking about and the things that I hear most from developers are, um, you know, wh- does my project pencil out? So one of the most common themes is, whether the site truly works before committing some significant amounts of time um, on, you know, planning and really design costs and capital and all of that, putting that time and effort and spending that money, is it worthwhile? And, in today's environment, it's made that process a lot more complex because financing, approvals, construction costs, lease up assumptions, and capital structures are now deeply interconnected. So the pro forma is no longer a static spreadsheet done at one moment in time. It's a live decision-making model throughout the entire life cycle of the project. So, when we're having these discussions, and sometimes it's with a developer that is a regular apartment developer, or sometimes it's a pivoting developer, and that discovery call is different in both cases. And there's three things that I wanted to share with you about a condo developer pivoting into rentals is, it's a shift. It's a total shift. And there's three major components of that shift. It's the thinking around operational considerations, right? You now have to think about ownership and operation. It's property management and, a longer term outlook. It's definitely a change in the capital stack, right? Condo developers are used to taking those deposits to help fund the construction. Well, that's no longer exists. It's a totally different capital stack. And Joanna's going to talk about that a little bit later on. But part of that pivot from condo to apartment development is the mindset and the DNA of the developer. And it often impacts the partnership structure and how they see returns and return metrics. So it's a real change in philosophy. It's something that we help developers make that shift in the swing. And, ultimately, what we need to focus on is, the fundamentals of the feasibility study as you work forward. So before I get into a little bit more of that and turning things over to Kanan to really walk you through a feasibility study, I just wanted to mention some of the other things that developers are talking about are working with the city. It's the approvals process and the timing of that. And that can be really challenging because they have made, your city approvals really impacts your, well, the carrying costs and your decisions at what point to get shovel in the ground and can I get my financing and that sort of thing. So it's all about financial uncertainty as well. So, we're going to talk today about the feasibility and pro forma at the feasibility stage. but it's also about financing and it's about the entire project because this is an iterative process. Now, what you need to be focusing on is figuring out and getting confidence that your site works. So you need to know, is this a rental pivoting into condos? Well, how much density is supportable on the project? Sometimes you come in thinking that you're going to develop a 500 unit development, and as you shift and you look at the market, maybe that needs to change. You also have to get confidence in, okay, well, what will the lenders finance and what assumptions are realistic, right? So these are some of the things that you need to uncover, discover, and really get confidence in. So one of the things, and I think this is a really important point. One of the biggest mistakes that we see in trying to finalize one of the biggest mistakes is that developers are often trying to finalize their construction costs before validating the feasibility fundamentals. So, and again, Caitlin's going to talk more in depth about the feasibility study, but you know, before you can accurately model your construction and financing or your returns, you first need confidence in your product unit mix, your density, your absorption, your revenue assumptions, your parking strategy, amenity strategy, and the overall market fit. And that's exactly where feasibility becomes foundational. That's why we start there. Don't figure out your construction costs until you know exactly what it is you need to build that's optimized for the site. So now Kanan is going to walk you through how the process works and how those variables ultimately shape the pro forma. So Kanan, over to you.
Perfect. Thanks, Dave. Appreciate the introduction there. And for everyone that, I potentially have not had contact with, I'm Kane McClellan. I'm the manager of the research department here at Rock Advisors. And, this afternoon, we're going to do a little bit of a deeper dive ultimately of, how we help apartment developers to make these key decisions, right? When, factoring in the feasibility study, moving that into a pro forma analysis, and frankly, using data-driven decisions to help guide us along the way throughout that process. So, with that in mind, we need to consider, well, how do you assemble a operating pro forma to begin with, right? And fundamentally, what does it represent, right? So, an operating pro forma is best understood as a structured financial narrative, ultimately, if you want to think of it that way. It ultimately explains the physical building or the proposed building and ultimately how that translates into incomes, expenses, and then ultimately the valuation as well. Right. So for lenders and investors, the purpose of a pro forma is not just to show upside, but it's really fundamental and, prudent that it demonstrates credibility, internal consistency, as well as risk awareness, right, of the overall market conditions itself. So again, like I said, within this webinar, we're actually going to be using a little bit of a live kind of pro forma experience that we're going to walk you through just the same way a lender would look at it, right? So again, that's really important to kind of understand and work through as well, right? And quite simply said, it's not just a spreadsheet, but it frankly is the financial story of a building, right? So again, we're going to be kind of walking through that here today. So one of the first things we need to look at, Rod, on the next slide here would be the built form, right? So what exactly are you intending on building, right? So every pro forma starts with what is proposed or currently what is physically there, right? So the build form is, foundational for the entire pro forma. Unit count, floor count, the net leasable area, these all come together ultimately to determine how much space can generate revenues and how efficiently those spaces are being operated. So operating assumptions, staffing levels, and even vacancy behaviors, right, all really come together and scale the need for the physical characteristics of the building themselves, right? And oftentimes, as Dave alluded to, developers, they're usually focused on rent first, but, oftentimes experienced underwriters, before they even look at rents, they want to understand the building itself and its characteristics. Right. So throughout this exercise here today, we're going to be walking through, like I said, a bit of a pro forma example. So again, you can see just some high level kind of assumptions and what we're going to be including within this pro forma analysis. So we're going to be assuming an 8-story building, about 100 residential units, 125 surface parking stalls, 50 storage lockers, a net leasable area 75,750 square feet, as well as an average unit size of 758 square feet. And again, oftentimes, if people get lost in the pro forma process, go back to the building. Really understand your building in depth before you continue along the way. And then with that, the next step, again, this dives right into the nitty-gritty of feasibility studies, but well, what should the unit size and mix be, right? So the unit size and mix in a pro forma ultimately determines who the building is designed for. Is it singles? Is it couples? Is it families? Is it seniors or empty nesters? And ultimately, that gives you valuable insight on how intensively the building would be used, right? So again, theoretically, larger units typically do produce those higher chunk rents, but it also expresses longer lease up periods and typically a little bit higher maintenance intensity, right? So keeping all these aspects in mind is certainly valuable when deciding what should the appropriate unit mix and size be for a development. And again, from an underwriting perspective, unit mix is generally a balancing act between revenue maximization, but also operational stability, right? And it's the unit size and mix. Generally, I like to think of it as a revenue decision as much as it is an operating decision, right? And it's critical to ensure that the unit size and mix really caters to the target resident profiles to optimize the performance of the building, but also aid a nice strong lease up, right? Which we all strive to achieve, right? And again, with that important, making these data-driven decisions always help lead us in the right direction, right? Ultimately, being able to identify that target resident profile and then fashion a unit size and mix that is appropriate and accordingly for that demographic profile as well is definitely vital. And then moving forward here, of course, once you fundamentally understand who you're going to be targeting, you need to figure out, well, then what are the rents going to be, right? And the rents in the pro forma are ultimately grounded by the research that's conducted within these market feasibility studies, right? So within these studies, we'll tie in comparable properties and analyze it to really determine where the rents are for each unit type. Excuse me. And again, we look at variables such as the actual size of the units, the finishes within the units, as well as the broader building as well, the amenity offering, the general feel of the building, but also the site location, because they all have different impacts on the rents being achieved at a subject site. And in addition to that, looking at a conventional approach, there's also a bunch of affordable aspects as well, such as the MLI Select program, which again, having those affordable units fundamentally do reduce those averages rents, but they do have improved access to financing, which Joanna will be able to walk through a little bit later in this webinar. And ultimately, this allows projects to remain feasible despite that generally lower income per unit, right? And although it is important to always maximize revenues, good underwriting is defendable underwriting, right? Making sure that you can defend your rents, ensuring that the rental figures are realistic, supportable, based on what the market and the proposed development specifically. And then, so again, generally, once we understand the unit size and mix and the appropriate rents, now you can see essentially an example of the top line of a pro forma when we're looking at the revenues achieved by those units specifically. So you can see here we've outlined, a very basic pro forma, right, for demonstration purposes, but we have studio units, 1-bedroom units, 2 and 3-bedroom units. So those studio units, as I alluded to earlier, is actually including the MLI Select program. So you can see about 10% of the overall unit mix is allocated towards affordable units. And you can see those market rents as well in that top line there on the monthly per unit category at $1,215 is quite a bit below where that conventional rent would be, right? But again, this is all justified within the feasibility study and uses data-driven decisions to guide us in this direction. But ultimately, once these rents are established, the residential incomes become simply mathematical, right? Where each unit type rent is multiplied by the unit count and aggregated to produce the total monthly rent. So in this figure, you can see the total residential rent is at about $233,900, right? And of course, once we transition that to an annual figure, you can see timesing that by 12, you then get about $2.8 million based off just the units specifically within this development, right? And this is the most sensitive input in the entire pro forma. And therefore, we know it's going to be heavily scrutinized by, lenders as well as CMHC themselves. And again, if your rental assumptions are misplaced, the pro forma will not be an accurate representation of the building itself. So it is prudent that you do get the rent right. And then in addition, just to the face value units and the income that you get from those units, what other revenue should we be considering, right? And other operational revenues consist of any auxiliary income stream that supports residential rents, right? So with that, you can see we have a couple of options here, and they're certainly not limited to this, but Parking, for example. Is it surface? Is it covered? Is it underground? Is it parkade? Is it EV, right? All of which have different fees associated with it that draw directly back into the revenue streams of the development. Storage lockers, right? How many storage lockers? What's the size of the storage locker? Drive fees as well, or other technology and lifestyle services, right? As premium Wi-Fi, smart home packages, or even bulk internet, right? It could be an example of that, or even in, more urban environments, valet services, right? Really unique items that can really help bump up those revenues when applicable, right? And it's frankly these revenues increase the total income, but are typically underwritten a little bit more conservatively than those unit rents, as they can fluctuate with tenant behaviors and market preferences, right? And again, developers should view auxiliary revenues as a helpful support, not the foundation of feasibility. So it's these secondary income streams, definitely help, but they rarely save a weak rental assumption within a pro forma. And then with that in mind, of course, we kind of looked at the top line, right, revenues respective to the unit types within a pro forma, but now we're going to be looking at those auxiliary revenues, right? So I don't know if you guys recall, but in this example situation, I identified 125 surface parking stalls, but it's important to note that they're not all achieving fees associated with it from the residential piece, right? So you're going to want to break out those items so that they're specific to the development. So in this case, you can see about 15 of those are allocated toward visitor parking, right? So we're understanding they're not going to be getting that $95 fee if it were to be a residential stall, right? Other items could be storage lockers, right? In this pro forma, we have about 50 of them at a rate of about $60 fee per month, right? And of course, this varies based off the size of the storage locker itself, as well as other items like sub-meter reimbursement, right, from companies like that. So again, if we look at each of these items individually, we can see just from parking alone, you can get an additional $125,000 per year into the revenues, or the storage lockers, $36,000 per year, or the sub-meter reimbursement at about $1,800 per year, right? So these definitely help to increase those revenues, right? And ultimately, parking assumptions, as I kind of highlighted here, must reflect actual utilization rather than the theoretical capacity, right? So again, although I said there's 125 stalls, they're not all achieving rent or fees associated with that. So making sure it's realistic to the actual building is critical, as well as the sub-metering, which I kind of touched upon, which essentially allows the landlords to recover a proportion of those utilities, while also encouraging tenant efficiencies because the tenants are on the hook for paying for their usage within the units themselves. And again, kind of speaking to this, overstated parking income is one of the most common underwriting flags that lenders see. And this further displays the importance of market research and having defendable assumptions by utilizing these data-driven decisions. So again, that's an example of those additional revenue or auxiliary revenue streams that you can expect to see within a pro forma. And again, like I said, they're not limited to those. There's many other ones, but just for demonstration purposes, we kind of kept it at that high level. So now that we understand all the revenues coming in from this development, we then need to consider the vacancy rates as well, right? And essentially, vacancy isn't necessarily a bad thing, right? Ultimately, it reflects the normal tenant turnover. It can be leasing downtimes as well as any frictional vacancy rates, even in a strong market, right? So you can see within this pro forma example, we assumed a 3% vacancy rate. And it's important to note that it applies to all the rents, the parking, and auxiliary revenues that we just kind of went over, right? To ultimately determine what that vacancy deduction might look like. And again, it's simple math where we look at those gross potential revenues times it by that vacancy rate to figure out what that vacancy deduction would then be. So in this case, we can see it's about $89,000, right, with the vacancy rate deduction. And if a pro forma assumes zero vacancies, right away we know it's not credible, right? And there's also other elements that need to be included, such as if it's a mixed-use building and it potentially has some retail or commercial assumptions within the pro forma, you're going to want to make sure there's a vacancy rate assigned to that as well. And rather than residential vacancy rates, typically those commercial vacancy rates are underwritten a little bit higher in and around that 5% range. So again, it's important to make sure that it's an actual representation of your building.
Yeah, and Kanan, before you move on, I just have a quick question for you.
Yes.
So, I mean, obviously, this is an assumptive scenario that you put together, and you see this all the time. Some of those ancillary revenues, like parking and lockers and all of that, is not rational in every site and every situation. How do you determine which site will solicit parking revenues at certain levels, if at all? And same thing with locker storages. How do you determine that that is applicable for that site?
Yeah, great question, Dave. And again, it kind of goes with where I started. Know your building, right? If you understand that, first of all, you don't have any overflow, kind of locked that space you can use, you understand that they don't have, or you have limited surface parking ability, right? So ultimately, understanding the site itself and the build form kind of guides you in the right direction in terms of, what would be appropriate for the site. But ultimately, once we land on, kind of what is appropriate for the site, it's backed by, market comparable properties, right? So with that, we'll do a deep dive into the market comparable properties, just like we did for the rents, right? So we see for a similar kind of product offering, what assumptions could be made in terms of the parking there, making sure that it's also a similar target resident profile and demographics, right? So ultimately, we can kind of align with where we think those fees would be associated with it. Because again, like I said, surface parking and underground parking versus EV parking, they all have different premiums and fees associated with it, right? So really fundamentally understanding your building and the comparable product offering in the market really helps us guide, the direction towards those answers.
Right. You're not just putting it in there to make the pro forma look better. It's very strategically mapped out.
That's exactly right.
Yeah. Okay, cool. Thanks.
Of course, no, happy to help. And then with that, again, we're then moving towards gross revenues to effective gross revenues. And again, fundamentally, it's simple math, right? Where we take those residential rental units, we add those auxiliary or operational incomes, and then we minus the vacancy rate from that. And essentially, that's how we land on the effective gross revenue or EGR. All right. And in this case, we can see it's about 2.8 or $2.9 million on the effective gross revenues. And ultimately, this represents the income that the property can realistically expect to collect, right? So in addition to that, all operating ratios, margins, and valuation metrics are typically calculated from this effective gross revenue rather than that gross potential revenue, right? So that's an important distinction to make sure that you're encompassing everything, right? The top line revenues for the units, the auxiliary revenues, and then making sure that you have those vacancy rates accordingly as well is prudent. So ultimately, that's kind of looking at the top line of a, pro forma, as we like to call it, right? Just strictly kind of looking at the revenues, but the other piece of that puzzle is the operating expenses, right? Which is, fundamentally, they reflect the day-to-day operations of a building. So this will be any ongoing or reoccurring costs required to operate and maintain the rental building in a stabilized condition. In this pro forma, the expense assumptions are informed by either a combination of CMHC underwriting benchmarks or actual operation costs observed in recently built or comparable rental assets. So these benchmarks help to ensure that assumptions, again, are realistic, financeable, and defendable, right? Which is something that I'm going to be repeating quite often throughout this section, making sure that we're, on the right track and, not pumping up anyone's tires more than realistic, right? And again, with that, expenses are often expressed as a percentage of the effective gross revenues. So lenders and investors, they can kind of quickly compare the operational efficiencies throughout different projects or even different markets in some cases, right? So you can see here we have a couple of just, benchmarks where typical stabilization range for that expense ratio is in that 28 to 33% range. And they certainly do go on either side of that, right? But again, we're just kind of looking overall. And again, this has a direct impact on the net operating income, which we're going to be kind of, relaying a little bit later once we work through the operating expenses here. But again, one important note is these expenses are often where that optimistic pro forma gets in trouble, right? Making sure that they're accurate assumptions and you're not underestimating them, inflating your, NOIs is prudent as well. And this will definitely be checked by both CMHC as well as lenders. So with that in mind, again, just talking about it holistically, now we're going to actually look at some actual examples, right? So you can see within this pro forma here, we've listed a variety of line items such as the utilities, maintenance and repairs, staffing, insurance, marketing, general administration, et cetera. And there's a couple more that on the preceding slide that we're going to go over. But ultimately, the utilities, this is for a common area only, what the developer is charged for, because again, we're assuming a sub-metered building here. So this will be anything like the electricity, the gas, the water, service corridors, the lobbies, the amenity spaces, the exterior lighting. This could be elevators and the building systems themselves, right? And again, in modern buildings, these in-suite utilities, like I said, are typically sub-metered. So A portion of that is paid by the tenant itself, right? Regarding utilities. When discussing the maintenance and repairs, again, this is the day-to-day building upkeep, right? This can include, minor repairs. It could be landscaping. It could be snow removal, waste management, and ultimately any preventative maintenance for mechanical and building systems as well, right? Making sure that the building is operating and staying on top of the maintenance of it. Staffing, another really important one. This could be either on-site or, contracted personnel. Anything like cleaners, building superintendents. This could be security where applicable, as well as leasing support, right? And again, staffing, this is one of those line items that scale with building size and level of service, right? So of course, as the building gets bigger, more density, you're going to want to make sure you have appropriate amount of staffing to be able to make sure the upkeep of that building is sufficient, but also in terms of the programming of the building, right? If you have more programming, for example, more amenity space, we understand that, there may be a little bit more in regards to that in terms of the service provided, right? And then other items is insurance, right? Making sure that the property and liability coverage is reflective of replacement costs or the risk profiles, but also the lender requirements where they do want to see this insurance line item cooked in there as well within the pro forma. Moving forward, we have marketing and leasing, for example. So again, this is going to be the ongoing cost to attract and retain tenants, right? So this includes advertising, this could be listing services, this could be the leasing materials. And it's important to note that, while lower in stabilized years, this line item, it never meets zero, right? You're always going to have a certain degree of vacancy and wanting to lease up that as well, right? So that's an important caveat. And again, like I said, all these assumptions either reflect CMHC expectations or benchmarks or verified costs from comparable stabilized rental buildings as well.
Kanan, one quick question. We all saw, and I think there's a lot of people on the webinar today that saw and experienced the cost increase throughout COVID, and that insurance costs is one that really saw a drastic spike. Are you seeing insurance costs now leveling off, or is that still on the rise?
Very good question there, Dave. Generally, I don't know if I could pinpoint that as of right now for you guys. So from my experience, it's definitely seeing a maybe taper off a little bit, but they're certainly a little bit higher than what they previously were, right? So it's
Yeah.
it's definitely, and again, we'll get into this, but sanity checking and sensitivity analysis on these numbers. That's another really, really important aspect of a pro forma, right? And again, that goes directly towards the credibility of it as well, making sure that you're realistic with your assumptions but looking at a best, based, or worst case, right? What development outlook
Yep.
could it look like, and then how does that affect your strategic decision making internally, right? So it's certainly a line item, and there's a lot of other ones, right, that can go up. On the next slide, we're going to be talking about property taxes, for example, which oftentimes
Mhm.
has the highest percentage of the revenues, the EGRs, as we were describing, right? So if you wouldn't mind just going to the next slide here again, we can kind of piggyback off of that conversation where, as you can see here, those property tax line items, it represents about 10.7% of the overall operating expenses within this operating pro forma, right? So again, they do vary, and it ultimately depends on, the mill rates associated with that as well, right? Within the city's perspective. And that also will give you a little bit of a sentiment of how willing municipalities are to taking on these development projects and other items such as DCs and whatnot, which we'll cover a little bit later. But again, very prudent, right? And making sure that you're on top and having accurate assumptions coming into this, right? So in addition to kind of those property taxes, we also have the property management fee, right? Which you can see here sitting at about 4.25% of that effective gross revenue. And again, this typically expressed as a percentage of the effective gross revenue. And it's important to note that even self-managed owners usually will include this expense, right? Because lenders and underwriters, they definitely look at third-party management standards in regards to this, and they want to see it in there, right? And then one other one, which is often a little bit looked over, would be the reserve of asset replacement, right? So this would be the fund set aside annually for long-term capital items such as roofing, the building envelope. It could be the elevator or any mechanical systems within the building itself, right? And CMHC, as well as institutional lenders, are going to want to make sure that those are adequate reserves for project asset quality over time. And again, when we're talking about a proposed building, you're maybe not thinking that far forward, right? But you're definitely going to want to make sure that you have that expense item kind of allocated within this as well, right? So that you cover all your bases, right? And again, like I said previously, these assumptions also do align with CMHC underwriting benchmarking guidelines, as well as those observed practices in other institutional grade assets. And again, if any of these items are missed, CMHC has no problem putting them right back into your pro forma, right? So it's important that you are credible and have these included when, going out and looking for financing and, discussions with CMHC.
Yeah, and as this is an iterative process throughout the course of the planning phases and beyond, Joanne is even going to talk about how some of the incentives might be able to impact property taxes and that sort of thing, but those get layered on later.
That's exactly right.
If I can, I want to add something about the insurance, which Dave just mentioned. So I do this this insurance expense is also a key underwriting element for the lenders and CMHC. So the insurance cost would be depends on how the building structures are. Are they like concrete or the wood frame? Like concrete would be have lower insurance, right? And also there's another situation is like because let's say my developer clients, they have already own a big, let's say they own 1,000 units, which they may get a good discount from their insurance company. So I always ask my client to get an insurance quote before they go to CMHC or the lender. That will help a lot because like different developer might have different insurance costs based on their experience, project management experience, the previous claim, things like that.
Yeah, makes sense.
Yeah, no, that's a very valuable point you bring up there, Joanna.
Yeah, go back to you, Keenan.
No, not a problem. Thank you. Yeah. So again, thinking about the flow of this, we've gone over the revenues, we've understood the vacancy rates, and now we kind of just touched on those operating expenses, right? So now once we put all those operating expenses together, it kind of gives us the picture of, what our obligation are on the expense side is, right? So within this pro forma, we can see it's about $848,000, which correlates with a operating margin or expense ratio of about 29.3% of the effective gross revenues. And it's this expense ratio that aligns with expectations for newer purpose-built rental assets. Lenders review this ratio closely as an indicator for the operational realism, but also the risk management associated with this. And then oftentimes when it comes to early underwriting, it's almost the percentage value is almost more valuable than the actual dollar amount, right, for lenders and from CMHC from their perspective. And so now again, going over the flow of things, we've kind of discussed the revenues, we've discussed the vacancy rates, we've now talked about those operating expenses. So when we put it all together, that's how we derive the net operating income. So we can see here, it's again, simple real estate math, where we're looking at the effective gross revenues of, in this case, about $2.9 million. And then we remove the operating expenses. So in this case, it's that $848,000 is highlighted on the slide there. And then once we minus those, that tells us exactly what the net operating income is going to be for a given project. And in this case, we can see it's just north of $2 million, right? And ultimately, this NOI represents the stabilized operating performance before financing and capital costs. And it is the single most important metric used to value a building and also determine what the debt sizing would be for that building. And one important distinction would be NOI is not profit, but what it is, it helps create value, as we'll see on the next slide here. So ultimately, once we have that NOI figure, we can then marry that with cap rates to figure out ultimately what the valuation or the estimated valuation of a building could be. So we can see here we have, again, using sensitivity and, having risk, factored into this. We like to think of it as best case, base case, and worst case. So here we can see there's a big difference between a 4.5 cap as opposed to a 5 cap in terms of the valuation, right? At that 4.5 cap rate, we see the estimated market value would be $45.5 million, right? Whereas if we're on that worst case at that 5 cap, it's just shy of $41 million. So again, the cap rate does have a big sway in terms of the overall valuation of the building. And again, in summary, The simple math is just you take that NOI and you divide it by that specific capitalization rate. And talking to the capitalization rate a little bit, this represents the investor's return requirements, but also the market risk perception, right? And applying this cap rate to the NRI, that is what converts the performance of the building to the estimated valuation range. And it's important to say range because, again, we're forecasting what it could look like, right? And it's this underwriting process, making sure that we're being credible and reasonable to land us on that decision, right? And this is why every assumption that we previously state matters because it has a direct impact to the NOI, which in turn has an impact to the valuation of the building or proposed building, I should say. So again, within the feasibility study report, that's where we like to land, right? What is the potential valuation of the building? But that certainly doesn't answer all of the questions in terms of return metrics, or other further assumptions that need to be in place in order to make this decision, right? So beyond the NOI and the valuation, as I've been discussing, returns are heavily influenced by the timing, the cost structure, and also the capital stack. Right. So the development schedule is critical because if there's any delays, it has direct reductions to those internal rate of returns. Right. Development costs, absolutely crucial to understand because it's these costs that determine the basis against which returns are measured off of. Right. So having a really good pulse on those costs are also prudent in having, really good estimated returns metrics as we're seeing here. As well as the financing structures, right, which Joanna is going to do a little bit of a deeper dive in the next section. But it's these financing impact returns through, both leverage, but also the cost of capital, right? In addition to the timing, right, of the cash flows, all of which are important. Looking at the return, you also need to consider the lease up time and the performance, right? This drives how quickly the project reaches stabilization and is often key, if you are looking to sell, what that exit strategy could look like. Right. In addition to the cash flow timing, it's not like all of these items are incurred at one period of time, right? It's important to, project them out when they're actually being, actually happening within the development cycle, right? And again, if you're not a merchant builder and if you're a long-term holder, there's other very valuable metrics that should be, looked at. This could be like the debt amortization or any big capital events like the refinancing, because that fundamentally affects the equity returns over a period of time, right? And again, like I said, we want to make sure that it is vital to evaluate risk through sensitivity, right? This could be on items such as costs, timing, interest rates, cap rate, almost all the assumptions that we've kind of gone through, right? And this is where it has the biggest impact to the outcome of the return metrics, right? So ultimately, development returns are shaped by how efficiently we manage these project costs, the structure of it, the timing of the capital, and ultimately executing on that schedule, right? Since timing, leverage, and the cost controls collectively determine the strength, but not only the strength, but the risk profile of the overall development, right? So in addition to just kind of those revenues, expenses, NOI, and valuation, there's a whole nother layer that should be considered, when projecting out and making these, strategic decisions.
So now transitioning from feasibility and the pro forma, we now want to introduce you to Joanna Zhao, our debt advisory and expert. And Joanna, over to you.
Thank you, Dave. Yeah. So before I dive into the numbers of today, we already have a lot of numbers right now from Keenan. But basically, what I hear from Keenan today is like we are building like I'm looking at a building is built up on paper or on spreadsheet. But that is very important for every developer should know before they go to their lenders. A little bit like it's not start like I joined a partner with Rock Advisor since this year, because I do have a lot of clients reach out to me for financing first before they have a clear picture of how they will design their building. I always discuss with them and especially the first time purpose-built rental, but I always found it's very difficult for me to get in if they don't have a clear picture of what they're going to build, because we would need a pro forma to work from. So feasibility study is very important to understand the like where are you going to build and what are you going to build, what are the building type. That is very important. Yeah, so that's why I think for us, we can work together. And then once this has been decided, we go to financial modeling, or we are calling like long size uh, exercising. Like based on this design, the long sizing will be like this much of loan amount. Would this be enough for you? And we will have like team exercise, go back to Keenan again. Yeah, yeah, thank you, Rod, for this. Yeah. So basically, this is what I want to deliver. The message I want to deliver today is like building design is really a team exercise. A lot of times we need to run quite a few performance back and forth based on like different design, or like if the loan requires some like energy efficiency or things like that, they will impact the construction costs as well. And also how you decide to go with MLI Select program, or if you are using like affordable or not, this will impact the city incentive as well. Like, for example, there are some development charge wave for like 3 bedroom. There will be a lot of like changing numbers for different aspects of our pro forma, and this will impact the full construction cost in terms of energy efficiency upgrades and also the construction cost. So in the end, it will affect our equity required for our project. So that will be very important. So in our services, like Keenan and I will go with the developer several, like a lot of time we are back and forth discuss like the best situation for the developer based on the less equity required and the higher equity IRR we're looking for. That is like everyone's looking for that two numbers. So that's why I'm very enjoyed working with Keenan's team, and also for a lot of my clients, this like the building design is very, very important. So next slide, please, Rod. Okay, so as I mentioned before, for purpose-built rental, we can have quite a few scenarios we can work with, and either under conventional or under CMC financing. Like this table present different maximum loan to cost or loan to value we are working with under different program. They will be different, but basically, if you can usually, if we can, the more points we're getting under MLI Select, because the lower debt servicing ratio and the longer amortization period, the highest loan amount we're going to get from the lender and CMC. And also we're getting some insurance premium off based on MLI Select, the points, how much points you get under this program. So but like for different markets, we will use MLI Select strategically, because in some markets, affordable might not be a solution for us to get 100 points. Just because if, let's say you decide to build in a market which the affordable rent is much lower than the market rent, then you are sacrifice too much rent for your income. And we all know income, like your rental income and your NOI is very important for your valuation, the end valuation of the building you're building up. So yeah, so basically we will not like dive too deep in how can we qualify under different program. And I believe this program has been in the market for quite a few times, for a few years, since 2022. So a lot of people might understand how to qualify, but just like for some knowledge sharing, somewhat, we don't need to, like for those like point system, we don't need to qualify for each system, like affordability, accessibility, and energy efficiency. We can gain points under each scenario to qualify under MLI Select program. Yeah, and we will have a more detailed session in the future to dive into different detail of how we can qualify under different program with CMC and what will be the key consideration and what should we do for us to qualify under those programs. But today, I just like follow Keenan's feasibility study to see how this will be like how different for each loan program will be work for different building type. Next slide, please. Okay, so like why the financing structure is very important for us. From this is the number I follow with Keenan's feasibility study, the pro forma, and I calculate the loan based on different scenario. So basically, you can see we have different situations. Let's say we can go conventional, but in this way, we can only get a lower loan amount because we are getting lower amortization and higher DSCR for the conventional loan. So that will be the lowest amount we are going to have. Basically, the equity required will be much higher than other program. If we decide to go with CMC, so CMC also has market program. Market program is a little bit higher debt servicing ratio, but it's still good for like compared with conventional, it still provide higher loan amount. So CMC even we're not going to go with MLI Select, we go to CMC market program, we can still get a good loan amount if this works for you. But as you can see, for this example, we will still need like 20% cost to like equity required for this program. And for the other scenarios, though, there will be 1, 2, 3, 4 under MLI Select program. So I would say MLI Select is very interesting. Like you can play with how you want to get, if you want to get 50 points or 70 points or 100 points, how it's your building can get points more easily in this type or in other type, because as I mentioned before, in some market affordability might make sense. In some market affordability doesn't make sense. So we will explore, okay, can we go with energy efficiency to just get 50 points, not with affordable? So that will have like different things. So for my scenario 3, we are assuming the developer is going to use energy efficiency to get 50 points, but just for everyone knows, like CMC's changing program, their requirement and the energy efficiency and the change will take effect since September this year. So if we like the new requirement is much more higher than before. Basically, right now, if we are going to get 50 points and the energy efficiency, we might spend like around like maybe, for example, 500K in energy upgrade. But under new requirement, we might need to invest more in energy efficiency that increase our construction cost, like in the end. So there will be consideration here. And also we can get, if we decide we're not going to energy efficiency, we can use affordable to work this. So if we decide to move to affordable in this way, like developer and me and Keenan will have a discussion to maybe rethink of our design. So here's our feasibility study is different from others. Is we not just like we give you a general consulting services to let you know, oh, this is what you should build, what is our suggestion. We also consider the debt situation. Like maybe if we want to do affordable, maybe we just assign a little bit more smaller unit in this market to run with Keenan, if this makes sense. If this makes sense, we can make our pro forma like in this direction. And if it doesn't make sense, we can still tweak a little bit. Okay, if we can get other points under energy or other points under accessibility. And so this is really a team exercising to hand you through how we can not only consider the building you're considering to build, but also how much the design of the building will affect your financing you'll get from the bank. So both are very important. And also, so I just dive a little bit, sorry, I haven't finished yet. The previous slides, please. Yeah, so maybe a little bit dive into the MLI Select 70 points. So this is affordable, but energy efficiency is lower. We just get 30, like level 2 energy efficiency. It means the energy upgrade will be lower. But because we are getting more, also I have to mention that like for affordability, we are getting some city DC waiver. So this all like just built into the calculation in the table I showed to you guys today. There will be like different. You do some like affordability which affect your NOI, but also maybe you get some incentive from the city. It will lower the construction costs. So we need to take this exercise to decide which direction you want to go. Yeah, and also we can have like 100 points. The 100 points we might have more city DC waiver. Yeah, so basically in this exercise, we do different loan sizing exercise under following Keenan's Forma. And you can see, based on different program we're going, the active required is getting lower. But the lower active requirement might be different in terms of the active IRR because of different construction costs. We still need to take that exercise as well. And also I want to mention, you can see on the MLI Select 100 points, active required is 0. Someone will ask like how that possible. It is possible because we can build in, like let's say we've make our loan exercise to almost 100% loan to cost. Then we will have some room to increase our construction costs by charging your development profit under project management fee or operating expense into our project to make you still get approved at 95% loan to cost, but you're actually getting back 100% from the bank. So that is the point I want to make today. And next one, please, Rod. Yeah, so basically this is the active requirements, different one. We can see they are lower and lower. And that's why a lot of, like in the end, that's why for this project, the developer finally decide to use MLI Select program because they get a lot of subsidy from the city as well. But again, each city are different. You will need to check with your city to decide if it is DC waiver or if it is some other incentive under different program by each city. So yeah, so this is, as I said, this is a team exercise. So it can be like developer, like I would say developer is very difficult to make these numbers work. They need to work with quite a few different consultants in different stage. Like they have mortgage, they should have like appraiser, mortgage broker, and also quantity surveyor. But in our case, we are providing all of the services we can to our clients to make sure you are building the most favorable building in terms of everything, if we can consider them. So yeah, so this is basically what I want to discuss today. Yeah, so basically in our exercise, we will consider feasibility study and long scenario analysis, and to if numbers work, but if it really works for your situation, and also some incentive integration, all of this into our feasibility study stage to make sure building you are building not just build the building on spreadsheet on paper, but you are actually getting the loan you are going to get from the lender and CMC, and also getting the city incentive from the city. We are just guiding you through from all of this application stage. Yeah, so basically this is the message I want to deliver today. And if you have any questions regarding loan sizing or have any questions about the like for detailed dive of the CMC options, we will need to cover it next time.
Thank you, Joanna. So really interesting. So we've taken you on a bit of a journey, and I want to just sort of bring it all together and stitch it all together. So as you can see, there are stages of a pro forma. So Kanan walked us through doing the feasibility study to come out with the stabilized operating pro forma. That becomes the foundation for the project, right? The pro forma evolves throughout the entire life cycle of the project. So in the feasibility stage, it's all about figuring out and getting product validation, right? Density testing, market assumptions, your revenue strategy, your absorption analysis type stuff. And what you're doing is you're creating a scenario now where you're feeding the financial model. So you're pulling in the revenues from the feasibility study, you're pulling in the operating expenses. And what you're trying to do is you're trying to take the assumptions out of it. You're now making concrete inputs into your financial modeling based on a strategic approach. Now, it's iterative. And really, what's important here is that you've got to layer in debt advisory and your financing options in the early phases, because ultimately, you don't want to wait till afterwards to then go to the lender and you've got architectural drawings and you go to the lender to see what you can get your leverage for the construction loan, only to find out your numbers aren't solid and they're not backed by data. So you do feasibility first, and once you start to establish what you're going to build and you can come up with your achievable rents, Joanna's team can start doing the underwriting on your construction loan. That gets you your maximum borrowing power, what kind of an interest rate that you can get on the various financing programs. And what you're going to start to do at that point is you start to fill out your financial modeling tool. If you have one, great. Start putting the inputs in and you're removing the assumptions. It gains credibility to the overall structure and you keep moving along. And as Joanna indicated earlier on, depending on whether you're going to go, maybe you have to shrink the project because Canaan has determined with the research team that the depth of the market isn't quite where you thought it was going to be, and you need to shrink the size of the project. You might go from, you might change altogether and go from a concrete build to a wood structure or vice versa. Well, Joanna's talked about what that does to your insurance rates. So as you make different decisions based on data, you start to lock in some of your assumptions. And then for insurance, you can go get a quote now based on a real project that you envision. You start tying it all together. So it's feasibility first with financial modeling as what we'll call your live pro forma. You're feeding it with Joanna's debt options in your construction loan, financing rates, your um, you know the interest rate that you're going to get plus the amortization period and what that does to the financial outlook over a 10-year period. And I think where some developers get really focused in the early phase is I've got to shave my construction costs or I've got to do some more value engineering and reduce my hard costs. But the biggest lever here that you have is optimizing the design of the building, the unit mix, and the revenue efficiency, right? To make sure that your absorption is going to be there and that you've got strong operational performance. And, I really want to make this point. 2 to 3% improvement in your long-term revenue performance can materially outperform small construction savings. Construction costs are a one-time fee. Revenue is ongoing, and creating stabilized operating revenue is critical to the success and value of the project. So, timing of debt advisory, you want to do that while you're doing feasibility. Once you get those rents established, you can start looking at your financing options and you start pulling those into your financial model. Um, your capital strategy should help shape the project, not simply react to it later, right? You don't want to go make all these assumptions and then go find out that the capital stack isn't going to work or you don't have enough equity. You want to start doing those simultaneously so you can build a project that works and one that you can get financed. And you learn early whether it's going to work or not, and you make the necessary adjustments. And our teams work with you to help bring those decisions together so that you end up landing on a financeable project. And, again, that's where the live pro forma comes into place. So sophisticated developers are continuously pressure testing the assumptions instead of falling in love with like one simple vision for the deal or the project, right? Be open-minded because it's got to work in the end and be able to get it financed. So, you know, I think one of the things, earlier on, um, property tax abatements approval is so Joanna, you had mentioned that at a certain point when you've kind of dialed in the type of construction loan you're going to get. Now, under MLI Select, obviously there's energy efficiency components in there. Talk to us a little bit more about how that impacts your ability to get your DCs waived or reduced and what that means to, you know, property tax abatements and the type of project that a municipality is looking for a developer to build. How do all those pieces fit together?
Yeah, basically based on my experience for working those performance with my client. So the DC wave is quite different under different cities. And sometimes the affordability requirement and the MLI Select is different from what city requires. Let's say in London, we have like 900 under affordable rent. We can qualify under MLI Select, but they have some program called, I forgot the name, but their number is like eight, like 838. So we need to make sure but if you want, like if you get that number, I believe they can get full waiver of those affordable rents for development charge. So we will need to make sure when we are talking about affordability level, we are talking about how we can qualify both under large program. And also, I understand some cities, Mississauga or Toronto, they are waived. The 3-bedroom DC are totally waived.
Yeah.
Right. So it will be an exercise. We need to work closely and very detailed for the numbers we're working with different cities.
Interesting. Okay. Now, Kanan, how often do you see developers overestimating what a site can realistically absorb within the required lease up timeline?
Often. I mean, in different stages too, right? Not even regarding the lease-up timeline. Sometimes it could be, they have a bigger vision for the site than the market is able to absorb, right? So, the density that they're proposing on the site is, we're suggesting maybe a little bit too aggressive based off the current rental pool or the, demand for that type of asset given the target resident profiles, right? In regard to lease-up and absorption, that's certainly market specific as well, right? What's going on right now in Kitchener is certainly different than what we're seeing in Barrie, for example,
Right.
right? So it really is nuanced where you should look at, the market specifically that you're dealing in to really understand, well, what are the lease up rates currently, right? What incentives are being offered, if any, right? How do you stay competitive within that lease up environment? All really important questions that need to be considered, right? So I mean, it definitely does vary, right? But again, we like to use data-driven decisions to help back that up, right? So here at, at Rock Advisors, we like to look at, well, what's currently being leased up in the market, what's proven already leased up in the market, and then use that data to ultimately kind of recommend where we think that, reasonable absorption or lease up times will line up, right? And again, like I said, it's different for every market, right? So it's important not to just look at, Ontario, right? No, you need to be more nuanced. And even sometimes looking at a neighborhood approach is prudent as well, especially in markets where there's a lot of density, like Midtown Toronto, for example, right? Where there's a bunch of new rental stock product there, right? So again, it's nuance and it does depend on the market you're in, but it's certainly, a very valid question and certainly worth, digging into further.
Yeah, and when you're doing the financial modeling, obviously you're running that out over a 10-year period, right? So you come in with the developer's assumptions on how long it'll take to lease it up. Once you get the project dialed in and you really learn and understand the dynamics of the market on the subject site, you can then adjust your absorption schedule to reality based on what you've learned through the feasibility study. And ultimately, I think, Kane, what we're trying to do is to get to those developer metrics, those return metrics that are going to show whether this is a project we should move forward with or not. So moving forward through the processes and really dialing this in can determine, okay, well, these are your 10-year outlooks, right? 10-year cash flows, 10-year IRRs. What's that look like? And that needle moves as you make more focused and targeted um, decisions, right? It's now taking the uncertainty out and dialing it into reality. And then, so now, Joanna, I've got a question here. So, um, how often, no, what are lenders most focused on today when evaluating apartment projects? What are they most, give me the top two or three that lenders are focusing in on.
Would be the rent. We would need to have very strong supporting documents for the rent because
Yep.
we are kind of experience rent decrease and the vacancy increase. So the rent level and the vacancy would be very important underwriting challenges from CMC. We've experienced some pushback from CMC in terms of the rent level we're presenting by the appraisal report, they're saying is too high. We need to use our numbers. And in a lot of situations, if we have our feasibility study or other third-party reports in hand, we can either provide before we submit it to CMC, or once they have some pushback, we have something in our hand to support our rents. We can show, okay, you may think the average rent for that area is lower than we presented, but this is how we design our building, what amenities we're having. This is like a different building in that neighborhood. Just provide like more third party, like our feasibility study to support our rent is very important for lender and CMC to accept the rent assumptions we're presenting. Also,
Yeah.
same as the vacancy rate.
So same we say to developers, the biggest impact you have is on the rent, and the
Yeah.
thing that lenders are looking at the most and needing most support for is the rent. So uh, good. I appreciate that. And everything we've talked about today is about a developer that has a project. They've got some vision for the project and what that could look like. And it's all about removing the assumptions and getting to a concrete data-driven project that is financeable. Now, sometimes we get developers that come in that are looking at acquiring land. They don't own it yet, but they're speculating and they're trying to figure out, you know, is this a viable property to build purpose-built rental on? And, you know, there's a way to go about that when you're trying to envision the viability of even putting an offer in on a site, or maybe you've already put an offer in and you've got an extended closing period on it that gives you time to do some due diligence on whether you should close on it or not. And that's basically, you can do this without actually having architectural drawings where you can create a project on paper where all you're doing is you're adding more assumptions in. You can see the sale price if it's on market of what a property could, the land itself could be worth. Plug that into your financial model. You could start then reversing this backwards and building a project on paper using some of the assumptions that we know from a typical project. So, Kanan and Joanna, you kind of walked us through an actual project, redacted, of course, for the purposes of this demonstration. But because you know how things are structured typically, you can actually work backwards and build a project on paper so that you can envision will it work even before you purchase the land. So that's just something to keep in mind. All of this stuff can be strategically mapped out even before you have a project at hand on a piece of land that you already own. So I just wanted to get that out there and leave that with everybody. We are over time, and I really appreciate everybody for sticking around. And Rod, I'm going to turn it back to you. We can answer any of the questions we didn't get to from the chats after the webinar, but I appreciate everybody's time.
Yeah, thanks for that, Dave. And yes, we will capture all the questions and follow up post webinar, but we do want to kind of reel things in from respect people's times. You will be hearing more from us about the remaining three segments for this series. And if you need to get in touch with Dave or anybody else on our team to get specific, because I saw some questions in there were kind of getting specific to certain situations, you can reach out to Dave. You can book time directly on his calendar here. Just screenshot this information. We'll put that in the email as well for you. And you're already here, and we've got, as we mentioned earlier, quite an itinerary of upcoming webinars and events. So stay plugged in. Thanks again, Kanan. Thank you, Joanna. Thank you, Dave, for being a part of this webinar, delivering a what sometimes is thought of as a boring topic, but probably the tip of the arrow topic in today's development world. So thank you very much, and thank you all for joining us, and have a great day.